As we navigate the complexities of global economies, the role of central banks becomes increasingly pivotal in shaping financial landscapes. Recent developments from the U.S. Federal Reserve mark a significant turning point as Chairman Jerome Powell announced the potential for imminent interest rate cuts. This move comes after years of high inflation rates, driven by the economic aftermath of the COVID-19 pandemic, which saw the Fed raising rates to their highest levels in 2 decades. Now, with signs of inflation easing, Powell suggests a shift in policy aimed at stabilizing the economy without sacrificing growth. But as the world watches these critical decisions unfold, the question remains, will these anticipated rate cuts provide the delicate balance needed to ensure a smooth economic recovery, or will they introduce new risks in an already fragile global economy? The turning tide, Federal Reserve's move to cut interest rates. In a bold statement at the annual Symposium for Central Bankers in Jackson Hole, Wyoming, U.S. Federal Reserve Chairman Jerome Powell declared, "The time has come for a shift in monetary policy." After a period of aggressive interest rate hikes aimed at controlling the highest inflation seen in a generation, the Fed is now poised to reduce interest rates, starting as early as September. This change signals a significant shift in the central bank's strategy as it seeks to bring the U.S. economy back to a state of normalcy without causing further harm. The announcement follows a period where inflation, which reached a peak annual rate of 9.1% in June 2022, has begun to retreat. By July 2024, inflation had cooled to a more manageable 2.9% thanks, in part, to the Fed's stringent policies. This decline suggests that price growth is now on a sustainable path, allowing the Fed to consider easing the tight monetary controls it has maintained for the past 2 years. Powell acknowledged the progress made in curbing inflation, but also highlighted emerging challenges in the labor market. Although the U.S. economy rebounded swiftly after the initial shocks of the COVID-19 pandemic, adding millions of jobs, recent data shows signs of a slowdown. Unemployment has ticked up slightly and job creation has decelerated, raising concerns about the potential downside risks to the labor market. Despite these concerns, Powell expressed confidence in the Fed's ability to manage inflation while supporting a robust economy. He emphasized the importance of adjusting policy in response to evolving economic conditions, noting that the pace and timing of rate cuts would depend heavily on incoming data and the broader economic outlook. 2 years ago, when inflation was spiraling upward due to pandemic-induced supply and demand imbalances, the Fed acted decisively by raising interest rates to levels not seen in 2 decades. These moves were intended to cool down an overheating economy and prevent runaway inflation. Now, with inflation showing signs of stabilization, the central bank is preparing to cut rates for the first time since the pandemic began, a move that could mark the beginning of a new economic chapter. The goal of the Fed's current strategy is to achieve a soft landing for the economy, where inflation is brought down to the target rate of 2% without triggering a recession. This delicate balancing act is no easy feat, and the upcoming rate-setting meeting in September will be closely watched by economists and market participants alike. The anticipated rate cuts are expected to be a gradual process, guided by the need to maintain economic stability while fostering growth. Across the Atlantic, the situation looks somewhat different. Andrew Bailey, the governor of the Bank of England, took a more cautious tone at the same Jackson Hole summit. He warned that the UK economy still faces significant risks from high inflation and that it may be necessary to keep interest rates elevated for a longer period to combat these pressures. Unlike the US, where inflation appears to be receding, UK inflation remains above the bank's 2% target, reaching 2.2% in July. Bailey's remarks underscore the varying economic landscapes faced by different countries and the tailored approaches needed to address these challenges. The Bank of England recently made a modest rate cut, reducing borrowing costs by 0.25 point to 5% following a similar move by the European Central Bank in June. However, Bailey cautioned that inflationary pressures could persist, particularly due to structural changes in the job market, which may lead to permanent inflationary pressures. The contrasting approaches of the U.S. Federal Reserve and the Bank of England highlight the complexities of managing economic recovery in a post-pandemic world. While the Fed is poised to ease its monetary stance in response to falling inflation, the Bank of England remains vigilant against the threat of persistent price growth. These divergent paths reflect the unique challenges each economy faces as they navigate the uncertain waters of global economic recovery. Critics of the Fed's handling of the situation have been vocal, accusing the central bank of being slow to respond to changing economic conditions. An unexpectedly weak jobs report in July, coupled with the Fed's decision to hold rates steady, sparked a brief sell-off in global markets, reflecting concerns about the central bank's direction. However, Powell defended the Fed's cautious approach, pointing out the unmistakable cooling in labor market conditions and the need to support economic recovery without precipitating a downturn. In his speech at Jackson Hole, Powell also reflected on the lessons learned since 2021, when many economists, including himself, believed that inflation was a transitory phenomenon driven by pandemic-related supply chain disruptions. This view was widely shared among central banks around the world, but has since been revised in light of persistent inflationary pressures. The Fed's earlier stance has faced criticism, but Powell's recent comments suggest a willingness to adapt and respond to new data as the economic situation evolves. As the world watches these developments, the stakes are high for both the Federal Reserve and the global economy. The decisions made in the coming months will have far-reaching implications, not only for the U.S., but also for international markets and economies. The potential rate cuts by the Fed could provide much-needed relief to businesses and consumers, fostering economic growth and stability. However, the risk of missteps remains, and the path to recovery is fraught with challenges. As we stand at this crossroads, one question lingers: will the Federal Reserve's anticipated rate cuts strike the right balance to ensure a smooth economic recovery, or could they inadvertently set the stage for new economic challenges? What are your thoughts on the Fed's approach, and how do you think it will impact the broader global economy? Share your opinions and join the conversation.